This is Nathan Thomas with the Alliance. On my previous video, I explained the 5 steps to the sales cycle with life insurance, and the 4th step was concepts. So today we're talking about a little bit about concepts. First off, I want to be clear that I typically, when I sit down with a client, of course, we're using the ATM. But as a visual, and I like to use a lot of visuals, I use laminates and just different stuff that I've gathered over time. But I always have a legal pad that I use and a pen because a lot of people are visual, and it's important to draw things out and not just talk about things and not just show things, but actually to keep their attention, draw things out and refer back to them. For the purpose of these trainings, I'm going to be using white paper and just markers or Sharpies, just so it's a little bit more visual in the video. So some of the concepts that I've come up with, one that I'm talking about in this video is final expense. One thing I found over time, first off, I love working with final expense. I love working final expense leads. I love dealing with seniors. It's a lot of fun. They're very concerned about taking care of their families and not leaving a financial burden for their families. They're great to talk to. They have a lot of experience, a lot of life experience that we can all learn from. But one of the things I found over time is every once in a while I'll go in a house, sometimes this objection will come up, even if it's not in a house that seems like the family has money, but sometimes people will come up with the objection of, hey, I think I'll just use cash to pay for my final expenses. I'm not sure if you've ever come across that or not, but I have. And so one of the concepts I use, or one of the techniques I've come up with over time that helps out a lot with this, is called the 3 different ways to pay for your final expense. So I'm going to just kind of role play real quick with Vio Pierre and Shayla Thomas and just talk them through as if they were the clients, this one concept. So we'll just go right into it. At this point in the sales process, we've already built rapport. We've already done a financial analysis. We've identified that they need to take care of this, and I've asked some questions. Okay, so we'll go right into it. So Vio, we're talking here a little bit about final expenses or taking care of paying for your funeral costs. Let me ask you a quick question. Are you aware that there's basically 3 different ways to take care of your final expenses?
No, I'm not aware.
Okay. Would you mind if I share with you those 3 different ways?
Yes.
Okay. First off, there's what I call the worst way. Of course, we don't want to use that method, but I'm going to explain it to you in a minute, okay?
Okay.
The second is the okay way, and that's okay, right?
Right.
And the third is the best method or best way of taking care of your final expenses. The worst way is when families, I'm sure you're not going to be in this position, but it's when families really haven't prepared at all, and there's a death occurs, and financially they're just not prepared to take care of a funeral, $8,000, $10,000, whatever it may be. So because of that, they have to get some sort of loan. And I say loan, but sometimes it may be also a second offering at church or a bake sale. That's still kind of like a loan. It's like not a guarantee. Or sometimes today what we're seeing a lot is, I don't know if you've heard of it before, but it's called GoFundMe. It's basically where you're asking people to donate. So a loan or donation. The reason why a loan financially is the worst way, it really comes down to math. It's because for every dollar that you need for your final expense, whenever you borrow money, guess who's going to win? It's going to be the banks. That's what we talked about before. The system's really set up where the banks always win. But for every dollar you need, it's going to cost your family $1 plus interest. Can you see how that would be the worst scenario for your family?
Yeah.
Okay. Mm-hmm. Like I said, I don't think you guys are in that scenario, but sometimes people are caught.
Right.
So you may have friends or family that you may be concerned about that I need to talk with that may be in that scenario. Okay?
Okay.
Now the second way is an okay way. It's basically when people have cash. Maybe money in savings, maybe in their 401k, whatever. There's this cash that's available to them that they're like, oh, I'll just use that money at the time for our final expenses. The reason why that's an okay way and not the best way is it really comes down to math again. For every dollar that's needed, the family's going to have to pay $1. Okay? And there's a better way than that. Do you want to know what that way is?
Yeah.
Okay. We call that leverage. The best way really is leverage. Or in this scenario, it's also called insurance. What we're doing with insurance is we're leveraging these multi-billion-dollar companies that we talked about, like Mutual of Omaha or whoever, that has a lot of money. And so in that situation, for every dollar that your family's going to need for your final expenses, whether it's $8,000, $10,000, maybe, you don't pass away for 40 years, they may need $20,000. For every dollar they need, they're going to end up paying pennies on the dollar.
Wow.
Versus $1 for $1. Can you see why leverage would be a more important or a better way of taking care of this?
Yeah.
Leverage or insurance. That's why it's so important that we talk about this. Also, keep in mind the money that's gained here, basically the interest that's gained, because you're only spending pennies on $1, is also tax free. It's one of the only ways to leverage your money and it be on a tax free basis. Does that make sense?
Yeah.
Okay, so we're gonna get into some numbers here in a minute on how to leverage the insurance company's money versus your family's. I hope that helps.